This is Tom Sargent talking about an application of complete markets models. And I'm going to use as my text for this baby's version of a model that Bisin, Clementi, and Gottardi invented to study incomplete market settings. So we could think about this as a prelim to their nice lecture, to their very nice paper, because it's going to set the stage. I'm going to have an environment that's exactly like theirs, except I'm going to allow complete markets, whereas they allowed, they shut down some markets in order to study some important issues in macroeconomics and corporate finance. So we could view this as getting us on the road to studying their paper. So in addition to doing that, we're going to use their model to study some classic issues in corporate finance that their model is ideally set up to study. And in particular, we'll have studied the Modigliani Miller theorem. Okay, once again, we'll see big K, little k issues that are all over macroeconomics and general equilibrium theory. So let's dive in. Oh, the text for this is a quantecon lecture, I should have said, entitled Irrelevance of Capital Structures with Complete Markets, that you can find on the quantecon site. So let's dive in. The economy is going to only last for 2 periods, t equals 0 and 1. And what that means, by the way, is that there's no difference between arrow de Brue and arrow, meaning time zero trading and time zero trading with history contingent assets, and time zero trading with arrow securities, because there's only 2 periods, and so that's just a remark. So there's going to be 2 periods. There are going to be 2 types of consumers, types. There's going to be large numbers of each type. I'll tell you about that in a minute. Their names are I equal 1 and 2. There's going to be a scalar random variable epsilon that's going to have some density g of epsilon, and that's going to affect that's going to affect both the physical return from investing in capital, and the return from investing in physical capital, and also the endowments in the second period of both types of agents. So we're going to use this as a device for setting up motives for trading risks. Okay. We're going to discuss 2 kinds of arrangements, as usual, when in macro, at least when we study complete markets. There's going to be a command economy, in which a benevolent planner chooses both K physical capital and allocates goods to the 2 types of consumers in each period and each random state. So that's going to be first arrangement, and we're going to use that to compute an allocation. And then we're also going to describe a competitive equilibrium with markets in claims on physical capital, and a complete set of there's actually might be a continuum of 1 period arrow securities, and they're going to pay period 1 consumption contingent on the realization of the random variable epsilon. Okay, that's a setup. Okay, so here's the deal. getting on the way to studying the planning problems, the aggregate economy-wide endowments are going to be W0 the first period and W1 of epsilon in state epsilon the second period. Period 0 and 1 we call them. Here's going to be a technology. If I put a superscript, it's a type of agent. So this is the consumption of the first person plus the consumption of the second person in times 0. And that can be equal to the sum of their endowments. I'm giving them their endowments. Dividing the aggregate endowment between those two, minus physical capital that's invested. So you can use the endowment either to consume or to invest. And then the second period consumption is going to, in state epsilon, that can be you can allocate it to person 1 or person 2. I'm sorry. Here's the endowment. Here's the endowment, and here's the return on capital. And what you get is if you invest K, you get AK to the alpha times E to the epsilon. E to the epsilon. Okay. Take a look at that. Okay. Preferences. A person I is going to have some power utility function, 1 period utility function. First period utility is this, and then plus beta times the expected utility from consumption in the second period 1. And there's going to be so people are going to have both types are going to have the same preferences. Okay. And following Bisin, Clementi, and Gottardi, we're going to have we'll often assume epsilon is normal, so that this physical return here is going to be log normal. Utility is going to be our power utility function, and we're going to have the endowments. They're also going to be log normal. So you take the log of the endowment, and this chi is going to be a volatility. It's partly going to it's going to affect people's share of the aggregate endowment. I shouldn't have said volatility. And we're going to have this being normal. So it would be helpful at this point to go to Wikipedia and look up a log normal distribution and how the moments of a log normal distribution are related to the moments of the normal distribution that's used to generate it. Okay, our Pareto criterion. We're going to have a planner that puts non-negative Pareto weights, I call them fees, on the 2 types of agents. So then we're going to form a Lagrangian. So we have a Lagrange multiplier on the time 0 feasibility constraint, and I'm going to put a scaled Lagrange multiplier lambda 1 beta lambda 1 of epsilon g of epsilon. I'm going to use that to do a scaled Lagrange multiplier so that the formulas come out nicely. So then I'm going to take that's my Lagrangian, and then I'm going to take first order conditions with respect to first order first period consumption times 0 consumption, the two types, second period consumption in state epsilon of the two types, and physical capital. So I get this condition. And if I rearrange them, these first four equations, I get the I get this condition. I get these ratios of marginal utilities between the first and the second period. In state, I might look like this. It's because of the way I scale the multipliers. And then the marginal utility, I get this is the key thing. I get what this equation is telling us is I'm getting constant shares at all time and in all states. That's what this is telling me. So these ratios of marginal utilities are equal to this ratio of these Pareto weights. And then if I combine those with the fifth first order condition, I get this marginal condition for the planner's optimal choice of capital. So this says 1 times, and this is true for either I. This is true for both people. I get this being equated, and that's a nonlinear equation. So in capital and the endowment, I'm sorry, capital and the consumption. So I have to solve these equations and the endowments and all simultaneously. Talk about how to compute one of these in a little bit with some Python code. Okay, so those are the planning problem. So let's do some bookkeeping. Get the standard. My margin utility consumption is equal to is power, and then I get so that the ratio of margin utilities and consumption are just going to be equal to C1 over C2 to the minus gamma. It's a ratio of the Pareto weights. So what that's going to tell me is that C1 over C2 is just these Pareto weights raised to the minus gamma to the minus 1. Just by taking this equation and solving it. So it follows from those two equations that, as usual in this kind of setup, we're going to get complete risk sharing. So this is going to be true for both dates and for all states. So what that means is if I use this and I knew this eta, well, what this means is there's actually a representative consumer, and the way I can compute, it's going to really simplify solving things. I could just take this equation and take these equalities of these marginal, take these results, plug it in, and I get this condition for physical capital. And this now, look at this equation. This is now is one equation in physical capital, because W1 of epsilon's exogenous. We made it up. W0 is exogenous, and we made up this distribution. And if we have to find a K that solves this. So that's one equation in K, and I'm gonna switch to big K now, because all of this was the planner choosing things. So I'm just gonna copy this equation and write it big K, and then I'm gonna have big C's and big K's, and I'm gonna once here's how I'm going to solve the planning problem. I'm going to have a big K that I get from here. And then I'm going to get my first period. Well, once I have big K, I know first period consumption in the aggregate, big C. I know, but then once I know K and the second period endowment, and I know this random shock, I know for every value of the random shock, I know what second period aggregate consumption is. And now I just take these ADAs, which are the shares, which I got as functions of the Pareto weights. Those came from this equation. I can manipulate this equation to get and the feasibility to get this. So now I have the consumptions of the two kinds of guys in all both periods and in all states. So that's how we solve the planning problem. Okay. Okay. So a few things to note. This is worth noting. The relative Pareto weight parameter. This ADA is kind of a function of those parameters. It does not appear in what determines K. So the planner is going to choose the same K no matter what how he feels about the two types of agents, the Pareto weights, and that's a property of our having assumed a power utility function that's common for the two guys and the common specification of utility. So it doesn't affect this, and it doesn't affect aggregate consumption over time. So the role of ADA, it's a nice partitioning here. The role of ADA is solely to allocate total consumption between the two types of consumers. That's the way this goes. So the planner's choice of K does not interact with how it wants to allocate consumption. Okay. So that's the planning problem. Okay. So now we're going to talk the competitive equilibrium, and we're going to draw some distinctions that are they're often in the background, but we're going to bring them out about why we assumed measures of agents, why Bisin, Clementi, and Gottardi assume measured agents. So here's the deal. There's going to be unit measures. There's going to be continua of consumers of type 1. They're all going to be identical, but there's going to be a continuum of them, of both types, and there's going to be a continuum of firms with access to the production technology that converts K units of consumption in time 0 into A K to the alpha E to the epsilon units of the time 1 good in state epsilon. There's going to be a whole bunch of these firms. Okay, and they're going to have these numbers. So talk a lot about big C and little c, big K and little k. So we're going to define a big C. I'm going to index a person by your name is going to be omega if you're a type 1 person, and there's going to be I'm going to define big C as this, where I'm going to integrate the little c's between 0 and 1. To get the K, I'm going to index the K by little k by this thing zeta, and I'm going to integrate to get big K. Okay, so okay, so the reason we do this formally is to they play a role in each of our agents is going to be a price taker. So an individual consumer is going to choose its infinitesimal part of this, it's going to choose this little CI part of big CI, taking prices as given. But prices are going to depend on the big CIs. It's going to take those as given. Same thing with the firm. Is going to choose firms are going to choose capital. So when people are choosing, they're going to ignore the fact that that there's a whole bunch of people choosing, making in their shoes doing the same thing. They're going to take those as given. Nevertheless, in equilibrium, big K is going to turn out to be equal to little k, and big C is going to equal little c. So spend some time thinking about this. Okay, ownership of type ownership. So now in a planning economy, we didn't have to worry about ownership. The planner just took custody of everything, told people what to do. But now we're going to have consumer I is going to own this part of the endowment, and when we that's going to add up to the total like we had before. Okay. Now, in addition, we have to say consumers are going to own shares in a firm. So each consumer is going to own a share in a firm that is going to operate a technology for converting. That should be converting non-negative amounts of time zero consumption good 1-for-1 into the capital. And the capital good is going to produce. So theta 0(1) and theta 0(2), those are the ownership of shares in the firm. And we set this up so that the continua of firms, the numbers match up with the numbers of people. Okay, asset markets. At time zero, consumers, and that's when the trades are going to occur, consumers trade these assets with other firms, with other consumers, and with firms. They trade equities that are known as stocks that are issued by firms, and they trade 1-period era securities that pay 1 unit of consumption at time 1 when the shock epsilon assumes a particular value. And later, I'm going to talk about bonds too, but not now. Okay, so now we're going to talk about a list of objects that appear in a competitive equilibrium. Okay, so AI of epsilon, those are going to be consumers' purchases of era securities. I'm going to let Q of epsilon be a pricing kernel for 1-period era securities. I'm going to let theta 0I, like I said before, it's consumer I's initial shares of the firm, and they add up to 1. I'm going to let theta superscript I be the fraction of a firm's shares purchased by consumer I at time 0. So this is the initial, and then this is what you decide to purchase. Okay, now since I have these era securities being traded, I'm going to have debt limits that are constrain firm I's issues of claims on time 1 consumption and state epsilon. So these are going to be my debt limits. I'm going to let V be the value of a representative firm. And I'll let V twiddle should be a twiddle above there, be the value of equity issued by the representative firm. So the firm's going to issue equity. Here it's going to finance itself entirely by issuing equity, but later we'll let it issue bonds. But now it's just going to issue equity. And then I'm going to let these things be scalars, and C1, these big C's, these are going to be objects that we use to construct a guess about an equilibrium pricing kernel for aero securities. So here's where my big C's and K's come in. Okay, let's talk about a representative firms problem. The value of the firm is going to be, so we have to ask, what's the value of the equities that it issues? The value of the equities that it issues. Well, it's just going to be, that's the return there. The return is going to be, in state epsilon, is going to be this. The price of aero securities in that state is going to be this. So the value of a firm that is invested K is going to be this V twiddle, just adding up across all epsilons. So the owners, the initial owners of the firm want the firm to maximize, well, the value of the equities. That's what it ends up selling, minus the costs of the initial investment. That's minus K, because those are just measured in we're measuring prices in consumption goods of time zero. So this is the value of the, this is what the firm's problem is, to choose a K to maximize choosing a little k to maximize this object given this whatever this pricing kernel is. So, you know, if we check this out, we do this optimization, the first order condition is with respect to k is we get a -1 there. We differentiate under the integral sign for this with k, and we get this is the first order condition for the firm. So the time zero value of firm is going to be this. Okay. Okay. Consumer's problem. Well, to do the firm consumer's problem, as usual, one of the first things we have to do is we have to figure out what borrowing limits are when we're trading these aero securities. So, so the way we do that now is we're going to think of a consumer at time. We're going to go into time 1 and see, well, how much could that consumer ever afford to pay off if he issued aero securities at time. If he issued aero securities at time 0, how much could he conceivably ever pay off? Would be feasible for him to pay off? Well, it would be his endowment, the exogenous endowment, plus the shares that he purchased times these are the dividends that he gets that he's entitled to. So these are his total resources. Even if he consumes nothing, we've set C in period. We set C in period 1 to 0 for this person. So that's the most he could pay. So that's going to be his borrowing limit. This is the maximum amount. This number is the maximum amount that the person could repay to his era security creditors at time 1 in state epsilon. So we're going to impose when the person issues era securities, we're going to impose this borrowing limit. If you check the signs, I think this is done correctly. Okay, so what's kind of nice here is if we stare at this and we see that look what his borrowing limit depends on. It depends on his time 1 endowment, and then it depends on his share of a representative firm's dividends. I could have put a big K there perhaps, because this little k is chosen by the firm. He doesn't choose this. The consumer chooses theta I. Okay. So these things, his endowment and his shares of firms, those are his collateral. You could think of those as collateral for the Aero securities. So that's in here. Okay, so now we can pose the consumer's problem. He wants to maximize this, subject to well, now he has a time 0 budget constraint, and he has a time 1 budget constraint. This is what this looks like. So what we do is we're going to attach Lagrange multipliers as usual and get his first order conditions. And when we do that and do some work, I invite you to work through this. We get that those first order conditions for the consumer, they imply that the consumer adjusts its consumption plan to satisfy this condition, so that the pricing kernel is given for the consumer, takes it as given, but it adjusts his consumption so that this ratio of marginal utilities times probabilities times discount factor is equal to that. Okay, so so stare at that for a minute, and then we're going to get some implications from this. Okay, so what we're going to do now is use it's a common method to derive restrictions on equilibrium prices solely by manipulating budget constraints of the consumers in the economy. So here's what we're going to do. I'm going to solve the time 1 component of the budget. I'm going to construct. See, here we have a budget constraint for each date, essentially. Well, I'm going to solve the budget constraint in date 1 for Aero securities, purchase of Aero securities, and I'm going to substitute that in to the time 0 budget constraint and rearrange. And what I'll get is this. What I'll get is this equation. On the right-hand side, I have the present value of consumption. That's the present value of consumption. And it has to be less than or equal to this thing on the right-hand side. So if we kind of to look at that, well, this first term is a my time zero endowment of person I. Second thing is the time, that's my initial values of the share. It's the value of the firm that I own, that I'm endowed with. Here's the present value. This is the present value of my second period endowment. And then here's theta I times this object. And theta I is the amount of shares that I have. And what this thing is that this is the present, this is the value of, this is the value of the dividends of the firm. And this is the value of the firm, V twiddle. And now, now we kind of notice that we kind of have a no arbitrage profits argument. Unless the value of the firm is exactly equal to this, there's an arbitrage profit. So you notice this. Unless this is true, the person could raise the left-hand side of this intertemporal budget constraint arbitrarily high, either by going long or short in these indefinitely long or indefinitely short in these equities. So go look at this argument. This is a common arbitrage argument. So that's the way to derive that this is the value of equities. Okay, so that's one thing we get from this. And then we get something else. We get there's a indeterminacy of the portfolio. So when this no arbitrage pricing equation prevails, a consumer's choice of theta I of equity is indeterminate, because the consumer can offset different choices of theta I by an appropriate schedule of purchasing or selling aerostate securities. So so in a sense here, there's the way we set this up. There's redundant securities. This person could actually just buy more aero securities. See, this term, as long as this is true, this theta I has no effect on his the left side of his budget constraint. So he doesn't care. He can move this to anything he wants. So I want you to think about this indeterminacy of the portfolio. This is in this setting. Okay. So how do we compute equilibrium prices and quantities? Well, we use our standard trick of taking the allocation that solves the planning problem, making a guess that allocation would be a competitive equilibrium, and then solving for competitive equilibrium prices. And to do that, we use a big K, little k argument. So in this passage, here's how we do it. We get our formula for Q. Once we have our formula for Q, we set K. And then the final step is then we verify that that if we we verify that all the necessary conditions for a competitive equilibrium hold when we plug in those prices. So that's what we've done here. I'm just going to close with a remark that I want you to focus on. There's multiple arrangements of endowments. See, the endowments, first period, second period endowments in different states, and the allocation of the initial capital of the ownership of the firms that are associated with the same distribution of wealth. So there's multiple endowment arrangements that lead to exactly the same distribution of wealth. I'm calling this eta. And you could kind of ask why. I've given a big hint. This is linked to the portfolio indeterminacy finding. And I'm going to stop here now. I have Modigliani Miller theorem, which we'll talk about in the next video.